Hello guys, glad to have you on board again. Today, as planned, we're going to record this session live talking about breakouts. We've got a few users in the live stream right now because it's obviously depending on their time and jet lag all around the globes. What we're going to do today is trying to explain most of the issues I've been coming across regarding users and breakouts and some of the misconceptions surrounding this big area. And this is really important for you to get this because breakouts does have an importance and high importance into applying the strategy. And having misconception at this stage can be a problem, so we're just going to try solving all those issues. Obviously, mastering the breakouts takes quite some time. It's not something you're just going to get out of the PDF manual. The PDF manual is just an introduction, and this is why we do those additional videos to just dig a little deeper into specific points of the strategy. So, first we're going to sum up the core informations because the usual question I get out of breakouts are coming from long-term users that have been used to use sine wave in its previous versions and are having quite hard times to get into using framework. So I'm just going to start with this, explaining why this is better and why this is not that different from what you had before. So obviously those who are new users here, those of you, they will just say, okay, I don't give a shit, I never used sine waves, so you shouldn't even give a shit about what I'm saying right now. It's just for those who are long-term users. So back then we were using sine wave indicator, an indicator that no longer gave access to new users to avoid confusion, but I have so many questions regarding this that I really need to start by that. So this is the indicator we had back then. So just to show you how better this is right now, let's just turn our framework. This is what we had back then. You just had cycles showing up as bullish and bearish cycles, and you had a momentum signal, of course, to add on top of this. And the way we were using strategy back then is that you were using those cycles to know which cycle you currently are, and obviously a bullish cycle doesn't mean the price will have to go up. As for example, in here the bullish cycle started in there but actually built its bottom pretty lower. So it obviously wasn't a magical tool, and you needed to understand how cycle prices in, and that doesn't mean this is going to work. It's just a predictive analysis, and therefore it has high value in a strategy but certainly cannot be used on its own. This is why we filter out all the wrong signals by using the momentum filtering on top of this. Basically, what we had in here, I kind of figured out this wasn't enough for beginners. It was more than enough for semi-professional traders, those who have like 3 to 4 years of trading. They know how to trade cycle, and they have some other tools they used to filter out unnecessary prices. So those guys were having absolutely no problem using the strategy and the tools I provide. But the most beginners of you, those who are trading less than a year, even how smart you are, it still is a lot of things to process, and therefore understanding the breakouts and the momentums and everything like that and all the processes working them together was kind of hard. And you were most of the time giving all your attentions to sine wave, far less on momentum, and you were forgetting about the most interesting thing in the strategy. You need to price filter first. And facing that problem, I had multiple solutions. Either I just gave you more educational content, which I did in the first place, but I saw even giving you more educational content wasn't fixing the actual problem. The actual problem is that you were focusing on what the indicators were showing you back then. Therefore, you had cycles, risk management from cycles, and momentum and risk management from momentum. And the strategy back then, we're telling you first you need to highlight prices that matters, and secondly you need to make sure that both cycle and momentum are favorable for a trading purpose. But what I've done right now is that as I needed to code something that will help you filtering prices, this is where framework came up. And I've been working on this indicator for quite some time to get to this actual looking we have right now with those channels, the trend channel, the context channel. A year from now, this thing weren't existing at all. So in the previous state of sine wave, I think it was compatible because this, and I stand on this, having a clear chart is absolutely necessary. the technical informations you're trading on and you're relating your trading decisions on must not take the entire screen. They must not delete prices or overcome too much information, just delete the actual information's advantage. So you need to have something straightforward, easy to read, and adding this on top of this, to me it's too much, and you guys shouldn't even handle anything like that because it's going to just bring confusion. So the starting point of deleting sine wave to put it into framework and momentum was, to me, absolutely necessary because it is something to move forward. It is an advancement in the strategy. It's better than the way it was before because you have more information, but still the rendering has to remain as clear as it was before. So staying the way it was for sine wave wasn't even an option. It wasn't even possible. So I had to delete sine wave, but just to remain having the same quality of price filtering. So what I did is basically I split sine wave into two things. All right, sine wave was two stuffs. In sine wave we did have the breakouts information and the cyclical information, bullish cycle, bearish cycles oscillating one after each other, and you had risk management from cycles. So it was studying the cycles to see, okay, this cycle has some bearish odds to create potentially lower lows, but as you didn't have any confirmation from momentum, it worth shit. You never traded just because of cycle. That's just as you wouldn't even try just trading just because of momentum. It was really combining the two that brings a decent risk limitation. So what I've done is that the cyclical analysis of sine wave, the patterns, I've been putting in directly into momentum, which means the momentum patterns right now includes both sine wave and momentum filtering. So it's easy because right now you don't have to compile those two. You just have all of them in a single area. Now you have a signal indicator, which is momentum. It's taking care of both cyclical analysis and momentum analysis in the same place. But still, after doing this, it would be the same as deleting the taking profit, exit, and things like that. It still remains with something pretty interesting and important in the strategy, the breakouts. So how do I code the breakouts into momentum? That's not even possible. So this is why I had to merge the breakouts into framework. So you delete sine wave and you assess that the previous breakouts now have to be implemented in framework, but in a simple way. I needed something to be clearly displayed and discrete, because the other stuff, the context channel, the trend channel, these are really important things, and you must focus your attention on them, because this is really step one. I want them to be clearly more visible and attracting attention than those breakouts, because breakouts will come in a later stage of applying the strategy. The first one is really, you need to make sure that you really get how to identify the context you're trading on and making sure that you're looking at prices that matters, because most of the time it doesn't even matter, and having a look at this chart just makes absolutely no sense. So first of all, you have a look at this, price filtering. We're not going to cover this today. There's already videos about that, and we're going to do just like we do today, some educational content, digging a little deeper into framework, but for now we're going to stick to the essentials, talking about those breakouts. So it's still pretty much the same algorithms and the same structure. So to do highlight this, I'm going to put the sine wave oscillator in here. I'm going to put it down. I'm just going to we're going to stick momentum. We're going to stick to momentum. So what we're having here is that you need to understand this is what happens in the background of framework of sine wave breakouts. So it's the sine wave oscillator, and we're studying how prices react to this. Remember that this is cyclical analysis. It's supposed to be predictable. So predictive analysis can be such a problem at some point, because you're never ever going to be able to predict the market. It is just risk limiting. So what's important about sine wave is not the sine wave itself, it is how you read the sine wave. So this is where's the added value, because I could just give you this. This formula isn't magical. I haven't invented this. The added value of my indicators is the way they read the cycles through price and detect potential divergence or convergence, and this is where the added value is. So of course I'm not going to give you my algorithms, because they would just lose value if I was just releasing the actual core information. So I'm not going to do this, but I'm going to explain you how this works, because you need to understand what happens in the background. Even though you don't exactly know how it's processed, you need to understand. So this is this thing that's in behind that was plotting the bulls and bear cycle back then. But the value was the taking profit, exit, structure, and everything like that. The structural analysis of cycles. These things still happens. They happen right now in here. They just combined by myself. Now you don't have access to momentum signals and sine wave signals. You got all of them processed together and just a single output for the two of them. All right? If you want to have access to cycle informations, just like we had back then, bullish cycle, bearish cycle, you've got this. You can show sine wave historical alerts. All right? I strongly suggest you don't use that feature because it isn't necessary. It's just for guys who were really, really liking the sine wave back then. This is how you're going to do this. So let it the time to process this. Oh no, sorry, I just deleted the output. So let me just put it back in the game. All right. This is how it is, all right? So remember that back then, all you had in here gives you the actual cycle you're into, which means you were bearish cycle and prices kept moving through this. So there's definitely a breakout in here. You can see the first bullish cycle coming right after. This is, for those who were using the old versions, this is definitely breakout, pullback, and end of trend in here. So it's the same thing. The information is still there. It's still available, just it's been displayed in a different perspective. All right, now I'm terminated with the previous version. We don't even going to talk about the previous version. I'm just helping you building a bridge to answer most of the questions I have for older users that are really concerned about the way they've been changing their behaviors. It is still exactly the same. You still have the same information, just what has been changing is the way they're displayed. But it's for the better. Definitely for the better, because now you still have the previous informations available, just differently, but you have far more informations available than you had back then. Now you have a price filtering algorithms just on your charts, and still, it is still clear looking, just like it was back then. So now let's get to the actual information. Talking about the breakouts, pure and simply. We're 11 minutes on, so I think it's more than enough, and time to jump in the actual information. So for those who are live, once again, you can ask questions if you still have concerns about how the strategy has been moving recently. It is about time to say it, otherwise I'm going to move to the next chapter, which is going to describing all those actual breakout informations, what are the different breakouts, how to trade them, and things like that. All right, so as I see absolutely no questions, I'll stick to this and move forward. If you do, you can pause them afterwards. I'll get back to it later. So I consider that now all the previous user and older users will have a clear sight how this is a benefit. And I strongly, guys, invite you to switch to the new ways. Even if it can be confusing at the beginning, it's really for the better. All right? I'm not doing stuff just to do stuff. I'm doing stuff only if it moves forward. I'm not moving backward. Never. Not in terms of technicals. All right? So now you do have the same information, and those breakouts are now represented no longer with a break signal, with a break label. It's more likely going to be those stuff. Those stuff is a mix. Remember back then you had a sine wave level, you had a sine wave label saying break, and you had a sine wave target. All right, so it was three information: the cycle level, the cycle label, and the cycle target when it gets broken. The quality of the screen share cannot necessarily be improved. I'm sorry about that. It depends on the quality I have, but I'm supposed to stream this in a 720 pixels, but the quality might be a little bit changing. So anyway, if the quality isn't that good, I hope it's at least good enough for you to watch the essential. We don't have to be really precise in here. I'm just going to change the colors of my lines right here, right now, so just probably it's going to be easier for you to see this if I just put it in a more visual perspective. Come here. Oh, god damn it. All right, so let's do it. So remember back then you had the cycle level in here, so you switch to a bear cycle, prices are breaking through this, the algorithms were detecting if this looks like a breakout trade, a range breakout or a trend breakout, and if it feels like it could be a trend breakout, it was writing down break and gave you a sine wave target. So three informations: the label, the sine wave level, and the target if the cycle goes broken. Now it's still the same thing. You don't see the level the breakout is triggered. You obviously have to do it on your own, but remember that you always have to break something. Something means normally it should be obvious for you to see what level is breaking through. And let's take, for example, a replay out of this area or this area. All right, this is a breakout, so let's put it back in perspective back then. You can clearly see that when we're here, I mean, the trend line is pretty fucking obvious. So do you really need an indicator that plots a line in here to tell you you're in a bullish cycle or in a bearish cycle? I think that's not necessary. It's way more important for you to have those cycles, those trend lines and channels. This gives a much more reliable information than having a cycle telling you that this is bull's time to trade or bear's time to trade. If you do want to have that, remember once again, you can have it in here. Even though I still tend to believe this information has to be secondary. It's not necessary, and it's just, I've been putting this for all the users that may use this information just to give them the opportunity to have it. All right? But I suggest new traders and those who've been learning the strategies since then you shouldn't even give a shit about that. It's not necessary in your learning process. Though, in here is the trend line. It's clearly visible. You can build a trend line in here. For now, we still have the breakout. We need to move on in time. Let's see where it showed up. Oh, pretty fucking lag. Thank you, TradingView. Alright, where did we go? Alright, here you go. Alright, breakout target has been designed. You can clearly see that we're breaking through the trend line. You've got a breakout candle, closing at the highs, alright, closing on top of the previous candle's highs. Everything in here suggests this breakout is valid, alright? You've just been checking on the information. Remember, these are algorithms. Algorithms can be right and can be wrong as well. So you need to verify information. This is how you're going to get the higher level of quality. So in here, definitely is a valid breakout. We can clearly see that we've broken up a definite trend line, definite level, and sine wave is detecting a change in the price structure. It's detecting that in here, price were supposed to go down, as this is a bearish cycle, and on the opposite, they're rising, and they're accelerating pace. That's how we detect breakouts through sine wave. So something doesn't go right. Normally, prices should go down. This is time for bears to trade, and bulls are breaking through them. So there is definitely a divergence between the predictive analysis of sine wave and the actual result that we have in prices. That's it. That's the only thing the actual indicator is detecting in the first place. That's the information we're going to take advantage of. Now, this is just detecting the information. How you're going to interpret the information is where the added value is and where those indicators will help you doing so. What they'll do is they'll detect the breakout and tell you this is what I think it is in terms of breakout. Because there are different breakouts. Back then, we had just two choices. We had the bullish, we've got the range breakout and we've had the trend breakouts. And that's the most reliable question you must ask yourself when you've got a breakout. Is this the kind of breakout that I need to follow blindly is going to trigger a trend, so I need to follow this breakout? Or is this just a random breakout that's going to push prices to a different location in which we're probably going to stop moving and reversing? And in that perspective, this is how you're going to trade the target. Because the target back then, remember we had three informations: the breakout level, the breakout target, and the breakout label. So now the breakout label, you're going to have to figure out if a label is necessary or not, but you're going to see it's pretty damn easy. It's just different. The breakout level, you don't have it displayed on the chart anymore, but when you see this thing, you just have a quick look at, did we actually break something, a horizontal level, a previous high, previous low, or a trend line? Normally, you should easily see what's been broken up or down. It shouldn't be a big deal. So I chose to delete that information in the new versions of those indicators into Framework. You still have access to the sine wave target because that's exactly it. So the level this little thing is going to be plotted at is the actual breakout level. All right, so it's the target level. Now you need to understand what a breakout means in a technical strategy, and for a professional, a breakout is just a change of mood, a change of pace. So that doesn't mean anything more than that. It's just the market is accelerating or the market isn't behaving in a cyclical perspective. And like we said, it can be just a range breakout, so we're just fucking up whoever was speculating in this area, and we're searching for higher grounds or lower grounds, but we're still in a range perspective. If we have that, then those breakouts generally gives you targets in which you can reverse trade, which means people will get in here thinking we're going to go straight line forever to the upside. Some people will trade this as a trend breakout, but you do have an edge on them, because after reading those indicators and knowing the rules, you should know that this is probably just going to be sold. This is going to mean that the guys who were thinking about a straight trend line in here, a straight trend, they're probably going to be proven wrong. So you take advantage of this information and you know that there is a selling opportunity in EURJPY. Because this, we're going to get to the conclusion later, and you'll see it's not that complicated to differentiate trend breakouts from range breakouts. Sorry, I'm moving. Is that clear since as we are right now? Do you guys understand what a breakout is? It's just a change of mood in the market. Now what we're going to exploit, next I'm going to explain you what this target came out of, what it represents into trading, and finally we get terminating how to differentiate the range breakout from the trend breakouts using simple rules. So if everybody follows, yes, we keep on going. All right. So the thing is that the breakout, as I said, is a change of mood. And what we're going to do is that the sine wave target isn't arbitrary. It's something that relates to actual trading information. What I use in here is the ability for trend trader, for breakout trader to highlight their own targets. Breakout traders are generally guys who are taking very low risk kind of strategy, which means they will be proven right most of the time. But they're risking just a lot, which means they generally have a 1-to-1 risk-reward ratio. All right, breakout traders put a stop loss below the previous low, and they're targeting a 1-to-1 ratio, meaning they're expecting to gain as much as they risk. Let's put it in a trading perspective and what it actually means into trading. So let's consider this is the breakout area. All right, this is the breakout level. We consider this is breaking the previous resistance. What we're going to do is taking the lowest close we had previously. So obviously my algorithms are not that simple. I have some counterbalance trying to figure out the most attractive prices. So in here you'll see it's not exactly this thing that happens, but most of the time this is the theory back working in the background of the indicators. I'm going to just search for the actual breakout level. I'm going to take the previous lowest candle closes and I'm going to port it to the upside. So why do I do this? Because I think it's magical tool? No, because it represents actual trading things that what professional knows, but most beginners don't know. All right, we're checking accountants of who whatever is doing what right now. When a breakout happens, first of all, before even figuring out if it's going to be a trend or not, breakout traders are trading this breakout and they're targeting a 1-to-1 ratio. So let's profit from that information. Let's put a goddamn target to this area and see what we're going to do afterwards. Is it going to be trending, something that needs to be followed through, or is it just going to be a breakout, which means breakout trader will profit take, market will reverse, and we're going to get back into the range area. So the first thing first, all right, those stop area, they will generally, meaning that this is a range, all right? So have you seen, there is 3 different types of breakouts. I'm going to just zoom out, all right? So is this clear, this 1-to-1 risk-reward ratio? You really need to get to this point. The 1-to-1 risk-reward ratio basically means that if the trader gets in here at the breakout level and puts its stop in here, it's going to target a 1-to-1 ratio. It's going to target the replicate of the risk it's been taking. All right, let's figure it out this way. All right. Let's say, like we said, it's going to enter in here, it's going to put a stop loss in here, and therefore it's going to target there because it's going to target exactly what it's been risking. That's how breakout traders trade. They take at a 1-to-1 risk-reward approximate ratio. And we take advantage of this information, which means this area in here, it means something. It means that the breakout traders have been paying for this shit, profit taking in here, and obviously whoever was stupid enough to buy that level just took a very bad decision. And having a good, reliable information, we would have profit from them back then and selling this area, or at least take the breakout trade, but taking on the gains in here, knowing that it probably will have retraced afterwards. All right, everybody's clear on this? The one-to-one risk-reward ratio and how I plot the targets on the charts and what those targets relate to and how important they are, what is the psychological structure behind it, you really need to understand this. This is clearly an evidence that you will profit from if you understand it. If you don't understand it, you're just going to trade random things, and if you use indicator not knowing why they do and how they process information, then it is worthless. I would like someone else than just Mackers tell me that it really got the point about the actual breakouts. Just at least someone else. I'm going to keep on going in between. I would like you guys to participate. I mean, if you don't, no others are listening, but they're just too shy. So no worries. Just take on your keyboards and say just yes or no will be more than enough for me. It's just that I know regarding the actual time scale we've been choosing to do this thing that we're just not that many to do it. But let's just use the advantage of doing it live. All right. So anyway, I know most of your concerns. I'm reading your emails, so I know what kind of problems you guys have with the indicators. So anyway, I know what questions I'm going to answer, even if you don't tell me. So anyway, this one-to-one risk-reward ratio is the absolute key information to understand what the breakouts mean in the pro strategy. And even aside from this, I mean, even if you don't trade according to my strategy, you can use that information that breakout traders tend to use a one-to-one ratio out of breakout areas. So now next question, how do you differentiate range breakout from trend breakouts? So three different types of breakouts that you may have noticed. What we're going to do in here is we're going to delete the prices. So you'll see that not even showing the prices, you'll have all the technical informations to highlight areas to trade. Just because price is secondary, all you care about is where price is at what time. All right? It is a matter of time and price. This is what trading is about. And some price at some time may mean something, but the same price at a different timing may just mean absolutely nothing. So really time is essential in trading, and if you don't get it, then you're missing a pretty fucking reliable information, and once again, you're going to profit out of having better information than others. This is the only edge you have into speculative trading. You don't have information before others, so the only thing you have is just the better information, and you need to profit from this. So, instead of taking stupid decisions, like some people in here may have said, all right, we're going to break in here, you should have known, you probably shouldn't even buy that price because first of all, it's a resistant context, you don't even buy in these areas, all you can do is selling, but the question was, is it reliable to sell this area, yes or no? In here, when you have this, I'm going to give you the structures, all right? So, we're going to start with the current breakout, right? The standard breakout. It's the cross signal, which means this will have to be contextualized. The cross signal can happen either in ranges, but it definitely normally means that a random breakout has been happening, and it requires just a simple reading for you to contextualize this stuff, and you can easily assess if this is a range or a trend breakout. The way you're going to do it, we're going to take those two examples in here. Let me just grab the pencil. Yes. So we're going to take an example out of this breakout in here. It's a cross signal, as you can see. We're going to have to highlight this one as well. And we're going to talk about this one. Because in here, you've got three different breakouts with three different informations coming out of them. And differentiating them is really easy. It just depends on the actual context you're trading on. Remember what contexts are? Alright, so this is the PDF manual in which you have the core rules, figuring out what the goddamn context you might be into, and moreover what maturity you're going to be into. So the breakout happens just in here, okay, which means how do you differentiate a range breakout from a trend breakout? Then simply the trend breakout is going to be this one. Every other fucking one is going to be a range breakout. So it's simple to differentiate them because this one will happen in a trend, and a trend is preceded by an accumulation. What is the accumulation? It is when prices goes from context back to trend channel, and the trend channel pushes price back to context without reaching the opposite one. So what does that mean in actual prices? In here, you definitely have something that matters and that fit the scenario. You have prices going from trend channel, from context channel, resistant context channel, back to trend channel, not reaching out to the support context, and going back to resistance. When you have this, you have a clear accumulation pattern. So that doesn't mean a breakout will occur. All that means is when you have this breakout, you know that this one is a trend breakout. So in here is where you know there is a trend emerging. This breakout, you don't trade the target by a reverse. You don't sell this target because this is a trend fucking breakout. So getting in here is where you put your stop loss as a break even and keep riding that goddamn trend. All right? And it's easy to see that because you can clearly see the accumulation. When this breakout shows up, how do you differentiate between range and trend? You have a look at what prices have been doing before. If you see an accumulation, it's probably a goddamn trend breakout. If you see nothing like that, then it's probably just a random breakout or a range breakout. So let's let's study this one instead. We're going to put us back in the replay function, so we'll see what was back then. We're just going to apply the same old rules, all right? So in here, we're going to move on until the breakout shows up. Oh, sorry, let's just move a little bit too fast. So now the pattern is in the game. So you've got the information. Something goes wrong with cycles because that's what the information relates. Something goes wrong, and it's a breakout that requires your attention. It requires you to read the context to know if it is a range or a trend. Is this something that you're going to pay the breakout, target the target, and push forward for more gains afterwards? A trend. Is this a target that you're going to sell to build a range? So all you're going to do is assessing the goddamn context. In here, do you see a single accumulation? No, you don't. What do you see in here? Prices reaching out the context and returning to context without even touching the trend line in here. So it may be an accumulation, but that's really far less of an accumulation. We barely retraced in here. So I would say it can be traded as a bullish breakout, but it really requires a lot larger stop loss. In here, you don't put the stop loss in here. If you want to buy that breakout, it's possible because as you can see, we might be accumulating in here, but it's indecisive. Indecision means high risk, so either you do nothing, and when you hesitate, you better have to trade a range than trading a trend because range occurs far more often than trends. Let me just highlight, as it's been put in as well in the PDF manual. All right, neutral ranges are most likely 50% of the time of context. Trends are just 20%. So if you don't know, then pick the one that has the most that is the most recurrent. The ranges will occur much more often than the trends. So any doubt, play the goddamn range. All right. So in here, this one is doubtful. It's hard to say if this is a trend because it doesn't fit the entire rules. It can be possible, but hardly going to be. So in here, you just don't know. So not knowing, you're not going to trade this breakout. Or if you do, you put a very large stop loss, and instead of putting it out of the previous lows, you're going to put it into the previous low, or even the major lows in here. But that requires a shit teeny position. You're going to play very tiny position sizing in here because, I mean, regard how big this stop loss is. Putting a stop loss in here is 32% of the asset. So does that really worth the shot? I would say no. So this breakout to me, in a speculative perspective, doesn't even make sense to trade. You don't know, you don't have enough information, you just pass on this one. You wait for further informations. All right? So let's see how it would have been played back then. All right? You just let it go. So if you're bullish, if you bought the speculative lows, obviously you just let it go. All right? And you're going to profit take at this target. But until then, you just wait for more information, more reliable information. Because remember what a breakout is. Oh, this could have been a good candidate. Remember that breakouts is when we reach out to context and we accelerate through both the trend channel and the context channel. In here, the two previous candles were pretty good candidates, but this one doesn't nearly fit the plan. As you can see, the breakout is not taking place. The buyers are not fooling. They're just selling out of resistance, which means the trend is still immature. We're reversing, and as you can see, back into context, that's a breakout failure in here. This is a breakout attempt that just failed. We're trying once again. Do you see prices accelerating throughout context and breaking the trend channel? No, you don't. Just delete the goddamn prices. Do you see any signs of accelerating pace in here? Absolutely nothing. They tried in here, didn't make it. Tried in here as well, didn't make it. Still, prices are going higher, so selling in here makes no sense, but buying a breakout doesn't make sense either in here. So it's probably just a range. We're searching for a range market top, working for a pullback, and after this pullback, we're only going to trade a possible trend. Yes, Tamara, accumulation needs to touch the trend. It is still, we can ride with the trend line, which means just pulling back close to, it's going to be more than enough. But in here, we kind of went not close enough to me. I mean, I would say the information is not clear enough to go for a breakout. And like I said, when there's any doubt, you just don't go in. Breakouts are really a tough matter. Taking a trend breakout is something that if you go wrong, is going to cost a lot. So you really need to have a very decent risk limitation. So any doubt means high risk, means either you take a tiny position sizing or you just do nothing. Sometimes doing nothing is by far the best decision. If in here is a pretty good example of a breakout that will not work out. It is just a fake breakout, and if you followed it back then, could have worked for a few weeks. You would have been happy buying in this price and saying, God, I'm so gorgeously buying this market, just to end up with a break-even loss. Because getting in here, you will see how brutal the reaction has been back then when the breakout has been reversed. All right? Just wait a bit. You'll see how it ended. Bam, you're out. You've been stopped. Not if your stop loss was there, but if you put the stop at break even, like taking the breakout and saying, I'm so good, I'm bullish breakout, even though this breakout is risky, I have confidence this will work out. Price, we're just proving you wrong in here. You were taking a little bit too much risk. Doesn't mean you took a loss, but at least you didn't take a gain, which means you've been risking something for no gain. So it is not good. So once again, on those purposes, any doubt should lead you to not decision making. It's always the best case scenario. You need to wait for further information. And as you can see, in here you're going to see the information following in here. Now, this is interesting. Now you've got this new breakout. So what is this? We figured out the cross breakout, which is a breakout that you need to read the actual context to have a binary decision. Is this a range breakout or is this a trend breakout? And it's most likely even simpler than that. The question is this a trend breakout? Is this fitting a trend context? If it doesn't, it's either a fake breakout or a range breakout, and they have to be traded both in the same way. You don't trade the range breakout. Let the DOMs do this. I don't say this is dumb, but this is the high risk kind of trading that I don't like because you don't have reward. You're taking high level of risk when you break out trade, but for the same reward. It's a 1-to-1 ratio. What my strategy provides is at least 2-to-1, 3-to-1, not even more than that at some points. So having the same level of risk, you definitely want to have at least 3 times the gain, and that's better. That's how we do speculate. So anyway, in here you've got the actual reliable information you were waiting for. You do have this. This pattern is detected after those, which means normally the square signal in here is going to happen after breakouts have been failing. And this algorithm is basically meant to detect one thing. It's going to detect irrational behaviors out of breakouts. When it's detecting noise into sine wave. And the fact that instead of having clear reactions, normally a breakout brings you fastly to the target because the market is losing grounds and is generally searching for new grounds and is going to rush prices up to the target normally pretty quickly. And when it's going to detect that something goes wrong, that we should have a bullish exhaustion move getting into the next resistance, instead of this, we've got some jitters and prices are falling back sharply on the opposite side. So the breakout attempt kind of failed. And when this happens, this kind of structure shows up. It is an algorithm that detects those conditions because those conditions have a psychological structures that we can profit from. In this context, it means the bulls tried and they were proven wrong. But does that require you to reverse the trade? No. It means in here you're reaching out a range boundary. This thing is generally saying, okay, we might be ranging from now because the market doesn't know what to do, and as it doesn't know, it means we're probably going to stay there for a little while until we've got further information. So this thing generally means that you're going to have a range. All right. So as those ones can be trend breakouts, these ones always say we're ranging. All right. Is this clear for everyone? The square signal means there is a range and it's undisputable. It is not something you discuss. It is absolute information. This means a range is showing up. I'm waiting for your confirmations, guys. I would say, okay, if you don't say anything, I'm going to keep on saying that everything is okay. And once again, if you have problems, if anything needs further explanations or anything like that, this is why we do this live, to make sure that you guys actually get the points. I speculate on the fact that I know your problems and I'm trying to answer those problems, but if I'm wrong, just obviously put me back in the line. All right, is there any context where a square breakout symbol should be ignored? Obviously, normally it should rarely happen, but when it happens in in the middle of a trend trade, you don't even focus about that. All right, ranges. Let me just put back the PDF manual. All right, ranges like that will certainly not happen if you just had a breakout and you're still at the divergence kind of pattern. It may happen in the pullback because the pullback to final excess is kind of an end of trend structure that may look like a range. So in those contexts, it may happen to have square signals, but in those contexts, breakout, divergence, it shouldn't be happening. All right. If you do have them, then definitely you ignore them, but normally they shouldn't even show up. All right. Normally this thing, unless you have a very volatile market, normally it shouldn't be showing up into trend context. I see very few possibilities it happens regarding the code. The code shouldn't be triggering into trend behaviors. All right, because it's more likely attempting to break, failing it, and sine wave detects something is wrong out of something that's already wrong. That's what you need to understand. This means something is wrong in the cyclical predictions that sine wave does. It just says something is wrong. That's an information that we can profit from. But this thing that means after something that is wrong by default, we're trying to exploit this information, but the information isn't working neither. So it is another information. It is problems out of problems into cycles. This is most likely what that pattern means. But this pattern doesn't terminate here, because after detecting something was wrong, the actual algorithm is going to detect if something else goes wrong, because when things go wrong in a pattern, then this pattern can be traded, because this is how you take the range boundaries. Ranges are multiple failures of breakouts, and when the market has been breaking multiple times in a row, even if that may sound like noise to most traders, this is the kind of information I use. And I coded this information, and you're going to see this, all right? In here, what is this? All those candles just don't even matter. This is pure fucking noise. You don't even analyze this. What do you do in here? The next analysis you do is either prices get into resistant context or go into support context. What you can see right now is that we're in between those two and nothing is interesting. So we let it go, we move on until we've got additional information that matters and gives us at least some informations. Oh, something here shows up, all right? So just like we said, this pattern isn't a cross signal. It's a square, and it's the second square in a row, and this one is at the opposite of this one. Remember what square means? It's noise, and noise rarely brings a trend. Normally noise may precede a trend, it's an accumulation, but it's definitely not the breakout trade. So in here, do you break out trend trade? No, you don't, because you had a first sign that's showing the market is jittering, the market is having indecision. This is just the opposite boundaries of indecision, and it's giving you a target. What it tells you in here is that the range might have been defined. So what do you do out of this? You take a goddamn rectangle, and you know that anything that happens in there is just pure fucking noise. You're just going to wait for prices to go either there and you sell, or either there and you buy. If you have a long-term bullish bias on this market like I would have had back then, any pullback in here is something you're going to buy. Alright? So now let's move on to see how it behaved. We didn't reach out to the target, but close to, as you can see, bam, top range boundary. In here you sell. You sell. You need a signal, and you just got it. It popped in and out, and I don't know, it didn't handle the candle close so far. As you can see, no signals for now, so you shouldn't have traded. No, no. Sine wave is okay, so we do have cyclical analysis plus a triangle. So I would say in here is not possible to trade. You don't have signals, but you certainly could have traded this in a daily chart time frame. I bet you had a daily bearish signal in here. So it would have been a daily trade into a weekly range context. Simple as that. You would have sold in here. Even if the market has a bullish bias in here, you would have just sold in here to take us a nice trend gain, and obviously lower leverage because you know the overall trend is bullish, therefore you're counter trend trading. You don't put a lot of risk in that kind of trades. So moving on. All right, is this clear about those squares? All right, never a trend trade out of squares. They're just here to help you reading ranges. And when you've got two in a set, all right, two in a row, an opposite direction, like a support square and resistance square, means that the range is defined and mature. So you can put the range boundary and try to play in between, but not too much. Remember, when we've been doing 4 contacts out of a range boundary, it means the range is mature and trend may emerge out of this. So the French guys have been asking a pretty interesting question this morning, and I'm going to answer this question even if you guys didn't ask for it. Is a breakout trade happening after and out of those range? Can we trade a range, a trend breakout out of this? Because this is a range, and when we break a range, generally we do have a trend trade. The answer is yes, which means those signals, you don't take them as trend trades. But when you break out of a range, mature range, then you can assess that as to be a trend trade. So we're going to move on to explain this in actual information. It's going to require us to go further in time. All right, now in here, we're back into our range, so we need to extend it to the highest close. All right, so we're back into the resistant context of a range. In here, a question rising, do we need to sell or do we need to buy? Like we said, selling in here kind of makes sense. Selling in here, it's the second time we're testing the semi level, and we barely got to the halfway through this range. All right? So in here, I wouldn't even sell that. All I would say is that I tried in here. I probably have taken a partial gain in here, but no more than that. Obviously, I would have targeted the lowest boundaries of this range as a final target. So it's probably selling, first profit taking, and stopped at break even. So in here, normally you're taking a stop out of your previous selling entry. So you're not going to sell the exact same thing in here, but what you're going to do in here is assessing that the price has more than enough time to range. Now this may look like an accumulation like we said, so what you're going to say in here is that if you do have another sine wave breakout, what is it going to be? Is it going to be a range breakout? Is it going to be a trend breakout? It's definitely going to be a cross signal, and it's probably going to be a trend breakout. The one you take, meaning that the market ranged out of here in between those two rectangle signals, square signals, and is probably about to take its decision. This range, we're going to take it out by the upside, and it's probably going to be a trend that's going to emerge out of this. This is the bearish attempt. This is the accumulation. This is where the bears tried, they are failing, and their failure may lead to trend trades. Obviously in here I'm taking the SPX as an example, so this is definitely one of the easiest markets to make that kind of analysis out of. But as you can see in here, alright, you would have eventually been taking another range trade in here. This one would have been pretty fucking risky, but normally applying the strategy I would have been okay for you guys to sell in here. Right? What you would have said is the range is just a little bit more extended, we still have no breakout, and you have a selling signal. This is a gray signal, so not the kind of signal you get very aggressive, but still, you could have been taking a range trade, bearish range trade in here, and targeting probably this area or this area. Alright, we move on. Alright, your range trade works just fine, you probably would have been first profit taken in here, the rest of the trade is a break even, and you let it go. But what happens? The market goes up again. Oh, the bears are really not strong in here, and we know it's going to happen because we've been studying already. The breakout's going to show up. Still not. And here it comes. Breakout targets out of your previous range. Now this time we're fitting the accumulation structure, we're breaking through context and trend channel. God damn it, this is a trend breakout. This is the kind of thing you buy, put a stop loss out of the previous low and ride it all until its end. What are the further steps? We're going to push this until it gets to the next step of a trend, which means this is trend breakout. You just get yourself into that goddamn trend no matter how long it takes until you get a divergence. All right, clear divergence between two tops out of momentum indicators. When you have this, you know that the trend is maturing. All you're going to have is a pullback before the final excess. All right, now let's put it out in perspective. How did it played? Oh my freaking fucking gosh. Exactly as expected. All right, we've been pushing until we've got to diverge in here. You've seen all those times the market failed to make new highs, so we started divergence in here. The pullback occurred in there, and obviously we had the final excess afterwards. So this trend has been following the path, the usual path and the usual structure of a trend, pushing straight forward, trending, pushing the context higher and higher and higher and higher. Okay, in here, instead of having a vertical breakout, we had multiple breakouts, prices remaining into the resistant context. All right, but this is where we got the tiny pullback and final excess. This trend has been terminating itself in here. This is a trend trade in here, pure and simple. All right, now let's move on. We said we're going to analyze those two. So let's switch back to replay. All right. So back in here, you got a breakout at 10. First thing you would have said is going back in there, when we were there, when this breakout occurs, first things first, you put a goddamn alert to this level. What is this level going to be? I want an answer, and I want at least one of you guys to give me the actual good answer. And normally, Jen, I know you know the answer, so you really need to give me the right one. This X signal, what is this? Yes, exactly. This is where you're going to get to profit taking. Remember what it is, all right? At this time, this one you don't even take it, because back then the price wasn't even divergent. So this one is, you're in a trend context. Remember that reading those crosses requires you to read the actual fucking context, because regarding the context is what you're going to know which kind of breakout this is. So as we are right now, when this breakout shows up, what kind of context are you into? You just broke up, you're still not diverging, so the current market state is in between those two steps, all right? So you don't even give a shit. Right here, right now, all of this makes absolutely no sense. This breakout is just a fake breakout. It fits no plan. So this information, you don't even use this because it's irrelevant. What is the next exclamation you're waiting for? Is to have the divergence. Now in here you see the tops are diverging. So now you know that the next breakout is probably be the final excess. But first you need a pullback. So now let's move on. Alright, you need a pullback. So you need to see the market pulling back to the trend channel. Still nothing. Here it comes. Pullback. So what do you do in here? You know that this shit has to be bought. So you're going to the lower time frames charts and you're looking at buying interest signals out of here. And I'm pretty damn sure that you would have had one in a daily or 4-hour context. You buy this dip because you're still trending. You were waiting for this pullback. This pullback is definitely going to be bought. You're buying this shit. Obviously you do. All right? Now you have the pullback, and what you know is, oh shit, there you have a target, so you know something in here is going somehow wrong. And you know that anytime we have a second target showing up in here is going to be our target. So this target, this one, I think it worth something. Remember that targets are valid for 50 bars, all right? So this one just was worth less in here. It terminated its action in here. This one still have 50 bars to go. But right now that you've done your pullback, you're looking at what? You're looking at the next step, the final excess. Prices return to context and framework shows a breakout. So this breakout is definitely the target in which you finally profit take. This is your final excess target. You just need a goddamn signal to profit take, but you know that in this area, okay, consider that breakout are not specific prices, it's just a price area. You know that in this area is where your trends is terminating. This is where you're going to have to stop riding that trend, profit take, and move on to something else. All right, good question, Tamara. Where do you put your stop loss when you reinforce on a pullback? The answer in here is pretty simple. When you take the pullback trade, normally you try to put your stop loss further away out of the previous support. So I would say you search for the previous major support. I would say this one was kind of viable back then. This is where you would have been putting your stop loss at the moment. If you don't know where to put it below the context channel. Far below the context channel. But this is a pretty expensive stop loss in here. So I would say in here was more than enough. Okay, and obviously you position size accordingly. If you want to put a very safe stop loss, you put it there, all right, below the Fibonacci 38% retracement. In here, you definitely know the prices won't go there. This is where we broke up. So if you put the stop loss at the breakout level, we should be safe. But the thing is that buying in here with that kind of stop loss is expensive. It's a 20% stop loss. Obviously, it's just shades of aggressivity. This is up to you. If you're an aggressive trader like I am, you definitely will put your stop loss in here because the stop loss in here costs us just half of it. It's just costing 6%. So this one allows you to higher position sizing, bigger position sizing. It is a matter of options. All I'm teaching you guys is that there is no strategy that works for everyone. The strategy is a framework that you use which is working fine, and then you personalize it to suit your own needs. We're all different, so everyone who's using my strategy doesn't have to use a hand-in key structure that is magically working for everyone. I give you the structure, you personalize it, whether you're aggressive, low risk profile. If you're a beginner, you're obviously going to have to not being aggressive. If you're a little bit more experienced, you can switch to those more aggressive profiles. All right? I hope you do get that because we've already been talking about this, so normally it should be known by now. So let's move on to the actual final information, the final breakout, okay, because there are three types of breakouts. There is this one as well, and you might wonder what the hell is this. Now normally this one is going to show up after the square signals. Remember what we've said about the square signal. Square signal will generally happen after the cross signal when we use this information that the market is reversing out of a range, but it's not behaving like it should. So we detect something irrational and we profit from this, saying irrational out of irrational normally means we're building some kind of a range boundary in here. And when even this doesn't work out, means the market is irrational out of some, it's not irrational, but it's acting abnormal out of something that is already abnormal. So it tried to break, failed to break, tried to break on the opposite side, not working as well. So range boundary. But if you're breaking this range boundary, then something is really wrong. But that doesn't mean the market is irrational for no reason. It just means there is also an information that we can profit out of in here. It's just a higher level of information. It's the rarest kind of breakout. This one, you generally see this one very rarely. You're most likely going to see those one more often, those one a little bit less often, and this one rarely. This one is absolutely, what it means is that something went wrong with the cyclical structures. So in here the bulls tried to take over, they failed. So the bears tried to take over, they failed. So the bulls should profit, but they don't. So something is really, really wrong. We're kind of messing around, the market is lost. When it's this, it means that we're still in a range. So this never happens into trending context. This is only happening into ranging context. All right? So there's not even a question about this is a trend trade or range trade. No. This information gives you an in-between stuff, the in-between information. It gives you the information of a trend range, which means trend following a major trend or about to create a new trend, reversing a major trend. So happening in here on the SPX, why do you think I'm selling that goddamn shit in the weekly chart time frame? Because I've got all information suggesting something is goddamn wrong about the bullish trend, and that this suggests the bears are already taking it over to bear trend, so to consolidate the long-term bullish trend. That also fits the slowdown economy, the end of economic cycles, everything like that. It's just all fitting the plan. That doesn't mean it's gonna work. All it means is that I've reduced my risk more than enough to trade bearish on the SPX in a weekly chart context. Future will tell me if I'm right or wrong, but all the information I have is that the bears really, really took over on the bulls in here. We're still ranging in this area, but this range has to be a bearish range. How do you trade bearish range? You wait for 61 goddamn percent retracement, all right? You wait for prices inside the context, and you wait for signal plus triangle. Just like the French users have been highlighting this morning, you guys have really good questions. It's just that you have to understand my answers. The guy just tell me, then Phil, if the strategy says you have to wait for 61% retracement and be in context, then why the fuck did you sell back then? You should have waited for right now to start selling. So now that you're here, what kind of answer would you give to that questions? Just to see if you understood what I meant, what the point is. Because this question is absolutely true. It's right. Obviously, if I followed the strategy rules, I would have waited for this to be sold in the weekly charts. So why didn't I? I hope some of you guys can get to this answer, because if you do, you're really going to understand a key element of this strategy. And I gave you a tip a little bit earlier, so normally you should have the answer as well. The actual answer is that it is a matter of aggressivity. I've been playing this really aggressive, really aggressive. I chose to bend the rules, and I basically anticipated the weekly chart scenario by playing it on a daily chart, so on a shorter time frame, to be more aggressive. And so far the market has just been proving me wrong. I've been way too aggressive. This is why I had to take partial stop losses on that scenario, because it doesn't happen as expected for now. But that's how it goes. Taking more risks brings definitely more gains when it works well, but it also brings up losses when it doesn't work well. I never know if a scenario is going to work or not going to work. All I can tell is that as long as I risk manage, I do my job. I really think I've been doing my risk management as good as I could do. And if it was to do it all over again, I'm pretty damn sure I would do it the same way. I mean, I've tried everything I could. What we have right now in the US is pretty much out of any usual standards, and we all figured it out, but it's still playing at the moment. I still don't know how this will end. I have absolutely no clue about that. So you really need to understand this. Being aggressive brings more gains. It also brings up the risks. And when the risks show up, then you're going to have to pay for it. That's exactly what's happening right now in the US. I chose to bend the rules, be more aggressive, and I might have to pay for this. I don't know the answer. I still don't know. It's real time. Future will tell me. Maybe I will just manage to get myself out of here with a nice gains. Maybe I'll just end up with a loss. But I had to trade this as it is because this is what the indicators tells me right now. All right, we've been getting in here. What is this? What is this? It's trend pullback. We've been trending, trend pullback, final excess. So what are we doing right now? The trend is over. To me, there is no bullish trend anymore. What we have in here is a range that is bearishly orientated. So I trade this as a trend, as a bear trend range. It's a range that precedes a bearish trend to me. And I have to trade this accordingly because these are the informations I have. You really need to understand that. I'm not future telling. I'm not future reading. I'm just risk managing. And everything I have in front of me shows me that the risk management must be done by selling and putting a stop loss at the market top. Because normally it's a bearish range, and therefore we should be setting lower lows and higher highs among this range. That's all I can tell. All right? So now I've finished the presentation. I've been digging way deeper than previously on every of those breakouts. So if there is still anything in here that you don't understand, it is about time that you tell me. Otherwise, we're just going to stop in here. I've got nothing more to say. I think I've been explaining pretty deeply all those breakouts types, but obviously if this is still shadowy or foggy to any of you guys, then please let me know. That's about time to do it. If you say nothing, I'm just going to understanding that everybody just got it. It's crystal clear, and there's no longer going to be a problem regarding breakouts. So I'm hoping I'm going to stop receiving emails about that. That doesn't mean you have to stop. Once again, if you have a problem, you reach out to me. That's why I'm here for. I'm here to help you. I'm not here to sell you goddamn indicators. So if you do have problems understanding how they work, anything like that, first of all, you reach out to the Discord users. And if they can bring you out an answer, then obviously you can come reach out to me. All right. Yes, good question. The thing is that the diamond structure, I should have said it. That's a really good question. You don't give a shit about prices. Remember what we said. It's basically the diamond structure is irrational, unexpected behavior out of an unexpected behavior out of a breakout. So it's unexpected of the unexpected. So at this point, the price level doesn't even mean anything. So I would say you don't, it could still mean something, because once again, it's a price structure. But the thing is that I wouldn't use that as a really reliable information. Take that as an even grayer signal. It's just something that you can put an alert in here just for the purpose of it. You can say that, okay, this area kind of could mean something, but you can't just trade out of this. You really you're gonna need to have additional information. Either the context channel is gonna be in there, or some Fibonacci retracement might be there, which is the case in the current stuff. So if you do take the Fibonacci retracement in here out of the overall goddamn trend, you're going to see that no, it actually isn't. I thought it was, but it actually isn't. So as you can see, this thing is just in the middle of nowhere. It makes absolutely no sense. So I would say this thing is not even a thing. But the thing in here is that what is reliable is not the level, but the information. The information is that you need to trade this as a bearish range. This is what the odds suggest. That doesn't mean the market will do it, because obviously the market may be irrational at some point. And I said if we rise, we'll rise for very bad reason, because right now economics are bearish. Everything suggests prices, structure, and economics are bearish. So we should go down. If we don't, it means that other things are driving this market. Emotions and everything like that. Could be a bubble. We don't know. We don't know. All I know is that we're going historical highs. I'm profit losing. I'm lose taking. I'm definitely taking my loss. And anybody who is trading this scenario, if we do historical highs, you get the fuck out. Because that just doesn't fit the technicals. And what we're doing in here is taking advantage of them. No more than that. We're not predicting future. I don't goddamn know what's going to happen for the US. I certainly don't hope that we're going to switch to recession. As a human being, I rather liked everything going fine and avoiding having some nasty financial crisis or anything that may come along a recession trade. All I fucking care about is I do have my life, I do have my personal behaviors, I do have my personal perception of economical structures or anything like that, of social structures. But in here we're talking about trading. In trading you don't trade because of your IDs and because you think the economic crisis kind of makes sense. You trade because technicals suggest something is going to push prices to the downside. Point. All right. If that's clear for everyone, thank you guys for being in here. I'm going to stop the replay, and so if you have any other questions not related to breakouts, then obviously I'll be there to answer them. All right, so that's it for the replay. Thank you guys who are going to be attending this in a replay. I know it's a little bit long, but definitely there was a lot to talk about. We're coming to breakouts. I needed to go into really that much detail, even though you don't really need to know all this, but at least I wanted to go as deep as possible, so those who want to have a deep understanding of those structures, normally I think I gave you more than enough to be feeding your necessity to understand what's going on. Bye guys.